Well, let's go ahead and get started. My name is Diana Polson. I'm a senior policy analyst at the Pennsylvania Budget and Policy Center. Welcome. Thanks so much for joining us. This is our third and final workshop session of our 2022 Pennsylvania Budget and Policy Summit. After this session, we're also going to be doing a workshop for a legislative panel discussion, which will be the closing session of this year's summit. So please join us. Last Thursday afternoon, our second workshop session addressed affordable housing and defending democracy. And both of these workshops are available for viewing online, and we can put the links to the recordings into the chat in case you missed those. So let's get started with our workshop. So I'm excited to be here to talk about how we can fix Pennsylvania's upside-down tax system. And I'm joined by the director of the Pennsylvania Budget and Policy Center, Mark Steer, and Representative Sara and Narada. So I'm going to get us started and then turn it over to the panelists for further discussion. And once the presentation is completed, we're happy to answer some questions as time allows. If you have any questions during the presentation, feel free to type them into the chat and we can address them afterwards. So let me start out by showing what we call our upside-down tax system in Pennsylvania. So this is a figure we show often, so many of you may have already seen it, but it's incredibly important, especially to this discussion. The Institute on Taxation and Economic Policy, also known as ITEP, ranks all 50 states on their tax systems. Pennsylvania is in what ITEP calls the terrible 10 most regressive tax structures in the country, meaning that our low-income residents are carrying much of our tax burden. So this figure shows that our state's lowest income earners, the bottom 20%, which is the column all the way to the left, this group of people earn less than $23,000 a year, and they are paying nearly 14% of their income in state and local taxes. On the other end of the spectrum, those in the top 1% of income earners who earn on average about $1.7 million a year pay only 6% of their income in state and local taxes. So in practice, our tax system puts the burden on those with the least ability to pay. And at the same time, the fact that the rich pay a lower share of their income on taxes means these individuals are not paying their fair share, and we are bringing in less revenue for the state. So why is this a problem? This is a problem because we in Pennsylvania are facing a severe public investment deficit. Our state's share of funding for K-12 schools is low. In fact, we rank 45th in the nation for our state's share of funding. This means that our local school districts, primarily through property taxes, must make up the difference. But as you can imagine, poorer communities are unable to raise the same amount that more wealthy communities can, which leads to great disparities between school districts. This has led Pennsylvania to have one of the most unequally funded K-12 education systems in the country. In Pennsylvania, the zip codes and neighborhoods in which children grow up in too often determine the quality of their schools. Pennsylvania also ranks 47th in the nation for per capita investment in higher education. So our college students are graduating with some of the highest debt in the country, with Pennsylvania ranking third highest for in-state tuition and fees for public four-year colleges. Pennsylvania also underfunds human services. We underserve those who are intellectually and physically disabled, those who suffer from mental illness, which is a crisis that has been exacerbated by the pandemic. Our state continues to struggle with an opioid crisis, with overdose deaths in our state nearly 2 times the national average. This is partly a sign of our failure to adequately fund human services. Pennsylvania also suffers from deep cuts to the Department of Environmental Protection, which obviously hinders our ability as a state to address issues related to climate change. But Pennsylvania's public investment deficit didn't just happen naturally. Despite claims that our government is growing out of control, it is actually the case that our state expenditures and revenues have been decreasing over time when you measure it as a share of our state's gross state product. Since 2012, our general fund spending as a percent of our gross state product has averaged between 8 and 10% lower than it had during the 15 years prior to that year. You can see there's an uptick in 2021-22 due to pandemic-related spending and relief, but the expectations are that revenues and expenditures as a share of the economy will continue to fall in future years. So we know a large part of our problem has been inadequate revenues. While our state, ends this year in good financial shape, we know eventually federal funds will dry out and our state will need to, again, create new reliable sources of revenue. But we also know that the solution should not be a general tax increase. The reason is that incomes have not grown evenly for all workers. This figure shows that between 1945 to 1973, the pie chart on the left, the top 1% captured about 3.4% of overall income growth. But then if you look at the period 1973 to 2015, the top 1% captured 46% of income growth. So raising taxes on everyone fails to recognize that in recent decades, the rich have gotten richer and the rest of us have gotten poorer or remained the same. So we also know the pandemic has had an inequitable effect, falling most heavily on the poor and on low-wage workers. So in this presentation, we're going to share with you all some ways to improve our upside-down tax system without further burdening those with low and middle incomes and making sure those with the most ability to pay are paying their fair share. So we're going to cover our proposal for a fair share tax. We're going to talk about corporate tax reform, and we're going to talk about passing a state earned income tax. And with that, I'm going to hand it over to Mark Steer.
Thanks very much, Diana, for that great introduction and sharing our general perspective on taxes. If we go to the next slide, I'm going to start talking about a fair share tax. Now, the fair share tax is meant to be a replacement for the Pennsylvania personal income tax. As you may know, Pennsylvania has a clause in its constitution called the Uniformity Clause. That clause says that any class of income can only be taxed at one rate. And that's why we don't have a graduated income tax in Pennsylvania. Everyone pays a rate of 3.07%. And whereas other states have graduated rates that can start as low as 0.5% and go up. In New York, I think the top rate is 10%, and then there's an additional millionaire's tax rate. Other states have relatively flat tax systems, not the upside down tax system like we have, because they combine a graduated personal income tax with sales taxes, which tend to be regressive, taking more from people with a higher percentage of the income from people with lower incomes, whereas a graduated income tax takes a higher percentage from people with higher incomes, and the combination gives those states a relatively flat tax. Here we can't do that because we don't have a graduated income tax, and we can't because of the Uniformity Clause. There are, however, ways to deal with this issue even within our Constitution. There are currently 8 classes of income defined under federal law. They're all listed here. I'm not going to read them out, but these classes of income are long-standing. They were created when the federal income tax was created back in 1913, if I remember correctly. And we're going to take advantage of these different classes of income in our fair share tax proposal, which, if we go to the next slide, I'll describe in some depth. So what we're going to do is eliminate the personal income tax. Oops, sorry, that's Siri. We're going to eliminate the personal income tax and create 2 separate taxes. One is going to be a tax on income, wages and salaries, and we're going to reduce the tax rate on wages and salaries. The second is going to be a tax on income from wealth. That's going to be a tax on some of those other categories, on business profits, on dividends, on capital gains, on rents and royalties. And we're proposing to raise the tax on income from wealth. So another way to look at it is we'll have a lower tax rate on earned income you earn through your labor, and a higher tax rate on unearned income, on income that you earn because of what you own. This strategy gets around the Pennsylvania's uniformity clause, basically because almost everyone has earned income. Most of us live on our wages and salaries. Relatively few people get a lot of income from wealth. Relatively few people have large stock holdings and have large owned businesses which generate a lot of profits, get a lot of dividends, and so forth. So if we raise the tax rate on income that mostly the wealthy get and lower the tax rate on what everyone gets, we will create a system in which the wealthy will be paying a higher share of their income in taxes than they do now. And the rest of us could pay a little lower share. So we go on to the next slide. There are two options we've thought about for this fair share tax, and obviously there are lots of room in between them to pick and choose some option that makes sense for us at any given time. The first option, which we've spent a lot of time evaluating, would increase the tax on income from wealth to 6.5% and to decrease the tax on income from wages and interest to 2.8%. That would raise $2.86 billion a year based on our most recent estimates. The second option is a much bolder option. It would increase the tax on income from wealth to 12%. It would decrease the tax on income from wages to 1.9%, and that would raise over $6 billion a year. I'm mainly going to talk about option one, but we should keep in mind that there's some place between option one and option two that might be optimal for our state at any particular time. So let's go on to the next slide. This is the impact of the fair share tax on Pennsylvania taxpayers. And this is from option one, but the option two would have fairly similar results. 46% of the households or families in Pennsylvania will see their taxes go down under the fair share tax. Under the fair share tax, 36% will see their taxes stay the same, and only 18% of households or families will see their taxes go up. When we go to the next slide, we can see who is actually going to pay more. And this chart is a pie chart that shows you what percentage of the taxes raised under the option one comes from which income group. Remember, that's the option where we raised 2.8 billion new revenues. 50% of that amount comes from the top 1%. Another 23% comes from the next 4%. So that means 75% of the new income will come from the top 5% of families. 13% will come from the next 15% of families or households. So that means like 88% of the new income will come from the highest income groups. Very little comes from lowest income groups. And let me explain who's in those lowest income groups, because you might wonder, how is this tax, if it's meant to make our system more progressive, raising taxes on people with relatively low incomes? We were puzzled about that for a minute, but we thought it through and we realized that what the groups with relatively low incomes but higher share of their income from wealth are mostly people who've inherited wealth. Young people who may not make a lot of money through their wages, but have been given some stocks and bonds from their parents or grandparents, and they make some income from wealth. These are people who are generally in pretty good economic circumstances and have very good economic prospects, even though their income is pretty low. And that's who we think will be paying the increase in taxes as a result of the fair share tax plan if it were to be enacted. Next slide. This shows who would get a tax cut under the plan. And you can see that the biggest tax cuts go to people in the middle and below. The middle 20% would get 29% of the tax break. People above them in the 60 to 80% will get 25% of the tax break. People below them in the 40 to 60% dial will get about 19% of the tax break. People below them will get a tax break. The very lowest income groups will not get much of a tax break under the fair share tax. And that's mostly because given the tax forgiveness program, which is a program that helps low-income people pay less in taxes, they're not paying that much in taxes right now. To address this problem, to focus more of the benefit on the very lowest income Pennsylvanians, we want to call for an earned income tax to be combined with the fair share tax. And that's what Representative Narada is going to be talking about in a minute. So if we go to the next slide, it will show you what the average tax change is. And you can see that for people in the top 1%, they will pay a lot more in taxes, $25,000 a year. Now that may sound like a lot of money on average, but remember the average income from the top 1% in Pennsylvania is $1.6 million. So we don't think that's a really serious hit on their well-being. The next 4%, from the second to the fifth percentile of households will pay on average $2,758. And again, that's not very much compared to their average income of $364,000. Between the 95th and the 80th percentile, upper middle income people, but not really wealthy people, they'll pay a little bit more on average, $342, but again, that's on an average income of $157,000. Below that, very few people pay more, and those who do are mostly going to be, again, people who've inherited wealth, but have low income, which we think are mostly young people with trust funds. Next slide. You might say, well, how is this going to impact the richest people? And whenever we talk about raising taxes on the rich, someone says, well, rich people are going to move. There's, by the way, a great deal of recent evidence that shows that people do not move from state to state or from region to region or from city to city on the basis of their tax rates. At any rate, there'd be no place for anyone to go, because even if we raise the fair share tax and income on wealth to 6.5%, the effective tax rate, the total tax rate taking into account all their income of Pennsylvanians 1% would only be 4.7%, far less than New York, the District of Columbia, New Jersey, and Maryland, a little below Delaware, and about the same as Virginia. Only Ohio would have a lower effective tax rate on top 1%. And I don't think people in Pennsylvania are rushing to move to Ohio for lots of reasons. And a higher tax rate would not give them one. So we don't have the data on the impact of the bolder option 2 fair share tax proposal, but we believe that it still would not raise the effective tax rate on the 1% above New York or the District of Columbia. It would still be relatively reasonable compared to other places. So that's our take on the fair share tax, and I'm happy to answer questions about that when we come to it, the question point. Now I'm going to talk a little bit about corporate taxes. We can go on to the next slide. Corporate taxes have been dropping as a share of general fund revenue since 1972. And the drop has really been dramatic. Back in 1972, 30% of the general fund came from corporate taxes. Now it's down to a little below 15%. Why has that happened? Well, 2 big reasons. One is we eliminated one of our 2 corporate income taxes, the corporate stock and franchise tax. That was the tax that mostly hit out-of-state multinational corporations, and it's simply gone. And then we've narrowed the base of the corporate net income tax, the other tax on corporations, which has limited the amount that people have to pay. These 2 steps cost us every single year about $4 billion a year in tax revenues. You remember Diana talked about the problem we have with our public investment deficit. Well, if we had $4 billion more to spend per year, much of that public investment deficit would be gone. We'd have the money for our schools. We'd have the money for our roads and bridges. We'd have the money we need for pollution control and for human services. We'd be in much better shape as a Commonwealth. Most of us would be living better lives right now if we had this kind of money to invest in the public sector goods and services that are central to all of us. Going on to the next slide, we can talk about Governor Wolf's proposed changes to the corporate income tax. For a number of years, he's been calling for a reduction in the corporate net income tax, which is 9.9% to lower it. We actually don't oppose this proposal. We think the corporate net income tax is a little bit higher than the national average. Not much, by the way. The national average is about 7%, and we're just a bit higher. Dropping it to 7% or to the level we set the tax on income from wealth and the fair share tax, where we'd implement that, would be a good idea. But we think that if we're going to do this, we need to have something called combined reporting. Now here I'm going to get a little wonky for a minute. You've probably heard us say over the years that 73% of corporations that do business in Pennsylvania pay absolutely no corporate income tax right now of any kind. That's partly because we repealed the corporate stock and franchise tax, leaving a corporate net income tax, which has a major, major loophole. We've called it the Delaware loophole. And here's basically how it works. We only tax multinational corporations on the basis of the profits their Pennsylvania affiliates report. And Pennsylvania affiliates of major multinational corporations, it seems, don't make any money in Pennsylvania. They don't have any profits. Now you might ask, how does Walmart and Target and the big oil companies operate in our state and not make any profits? You might also ask, why are they here if they're not making any profits? Well, the fact is they're actually making plenty of money, but through the magic of intercompany accounting, they don't show any profits in Pennsylvania. How do they do that? Because Pennsylvania affiliates pay the multinational corporations that are based outside the state, often in Delaware, which is why we call it the Delaware loophole. We could also call it the Cayman Islands loophole because a lot of them are based now there, not even in this country. The Pennsylvania affiliates of those multinational corporations pay various things. They pay management fees to the multinational corporation for the work they do in helping them earn money in the state. They pay royalties for the use of technology. They pay licenses for the use of logos. They pay money for advertising run in our state, but paid for by the national government, by the national corporation, rather. So when you take into account all these intercompany transfers, profits in Pennsylvania corporations drop down to basically nothing, and thus they don't pay taxes on them. Now, there are two ways to fix this problem. The simplest way is something called combined reporting. What combined reporting is a system used by 26 states, as we'll see in the next slide, but don't go there yet, that says if you earn X% of your sales in our state of Pennsylvania, then we're going to tax you on X% of your profits. So we can do this either within the United States, or we can do it worldwide. We could say if 3% of your worldwide sales take place in Pennsylvania, then 3% of your worldwide sales of your worldwide profits will be taxed by our corporate net income tax. Or we could do it, that would close the Cayman Islands loophole and the Delaware loophole, or we could just do it within this country, only closing the Delaware loophole. This is the simplest way to ensure that corporations pay what they owe in taxes to our state. The governor in previous years has called for combined reporting. Unfortunately, this year he has not done so. Instead, he's called for what we call add backs. He's basically saying Pennsylvania corporations that don't report any profits here, they have to add back some of those intercompany transfers. He's calling for adding back some of those management fees and some of those royalties and a few other things. This would help a little bit, but there's two big problems with what the governor's proposing. One is it doesn't capture all the intercompany transfers that reduces Pennsylvania corporations' profits to almost nothing. So we won't capture all the profits they earn in Pennsylvania. And second of all, over time, these add backs become less effective. Basically, when you close add one add back, you're closing one part of the loophole, but one way in which they transfer profits from Pennsylvania to the multinational corporation based in Delaware or the Cayman Islands, but they can always find another one. So it's kind of like playing whack-a-mole. We actually did this a few years ago. We instituted a couple of ad backs, raised a little bit more money for a year or two, and then we kind of lost it. So just doing ad backs means you're closing whack-a-mole. You're doing whack-a-mole. Close one, close another, close a third one. You ultimately do not get the real profits that are being earned in Pennsylvania, but are not being shown on the books of the Pennsylvania corporations. So we very much opposed government's proposal this year, and we're going to call for instead changes in corporate net income tax that include combined reporting. We think that's basically the gold standards, the way to do it. And let me make clear, there's no economic benefit to corporate tax reductions. We're not calling for corporate tax reductions to a little bit lower because we think that'll help our economy. It just won't. There's all the evidence in the world that shows when states reduce corporate net income taxes, they do not get any economic benefit. And there are examples, Louisiana, Kansas, which you've probably heard about, where they cut business taxes, and what they did, they destroyed their revenues, but did not help their economies. In fact, their economies got worse because they had to cut spending that is critical to business growth. The only reason to cut some of our taxes is because it's really unfair that Pennsylvania corporations pay at very high rates when multinational corporations pay nothing. And we'd like to, by raising more money from multinational corporations, we could help Pennsylvania-based corporations. So one last slide, and then I'm going to turn it over to Sara. This shows you that combined reporting is not this radical idea. 28 states, including the District of Columbia, have combined reporting right now. It works fine. It would be a very simple system for corporations to follow. They already know what their worldwide profits are because they have to report it to those 28 states. And then it's a simple calculation for them to figure out what they owe in Pennsylvania. They don't oppose it because it's complicated. They oppose it because they don't want to pay more taxes. They don't want to pay us what they owe. And that's really a shame. With that, I will stop and turn it over to Representative Sara Narada.
Thanks, Mark. Hi, folks. I'm Sara Narada. I'm a state rep out here in Pittsburgh and Allegheny County. I just first want to thank you all for diving into the tax code with us. I mean, I think when most people think about taxes, they're like, yawn, why would I ever want to pay attention to that? To me, when I talk about money for public programs that are overwhelmingly popular, income inequality, racial wealth gap, and even making our democracy stronger, all roads lead to the tax code when it comes to addressing those things. So, for me, when I got into office in 2019, I was like, I want to get on the finance committee, which probably should just be called the Tax Breaks for Corporations Committee, to really dive into this. And I hope to one day achieve the wonkery that Mark Steer possesses in when it comes to economics and tax code. But I just want to continue with what Mark was saying around corporate taxes. And so these are just some Department of Revenue numbers from the last fiscal year. These are where the bulk of Pennsylvania's revenues come from. So the personal income tax that is paid by you and I when we go to work and we get a paycheck, that's the bulk of it. Also small businesses, things like that, they pay the personal income tax. That's overwhelmingly where we get the bulk of our revenues. And then the sales and use tax is the next one. Which we know can be one of the most regressive taxes because it impacts low-income people more than it does folks with more wealth. And then, as you can see, there's this chunk of the corporate net income tax. Next slide. And I think it's really important to point out who actually pays the corporate net income tax. Like I said, it's not every business. It's not when I walk out my front door of my office and I go to the coffee shop down the street, they're not paying CNIT. It's much larger corporations. And in fact, we have 92,000 C Corps that are registered in Pennsylvania. And I think it's important to talk about what their liability is. So we have only 39% of those C Corps actually pay anything. So 61% of the corporations that operate in Pennsylvania pay zero. And as you see from this chart, that is the vast majority. And because we only have 2% that has a liability over $100,000, that's such a small percentage of the overall corporations that do business in Pennsylvania. And there's a couple of reasons for that, and we'll explain on the next slide. So we have our personal income tax is uncoupled. We'll talk a little bit more about that when we talked about the earned income tax credit. But our corporate tax code is coupled, which means that corporations can reduce their state tax liability by using the different programs and loopholes that exist at a federal level. Like Mark said, it's because combined reporting is not required. And there also are a number of other tax credit and what's called economic development incentives that exist in the state that all C Corps qualify for. And we can go to the next slide and take a quick look at those. So this is from the Department of Revenue, some numbers on how much these tax credits actually impact our state's ability to get revenue from the businesses that operate in Pennsylvania. And there are different types of tax credits. Ones are donation-based, meaning that like a company gives money to a nonprofit, and then they get a tax write-off. But then there's also these other programs that we call incentives, right? Which is just, they get tax credits. They can apply that to their tax liability, or what happens in a number of these cases is they actually sell them to other companies so that they can be profitable. And we've seen that in a number of tax credit programs, specifically around ones that are targeting the petrochemical industry, is that these facilities would not be profitable but for the tax credit programs and the tax subsidies that the state gives them. So, you know, the free market, great. And the total expenditure to the state is now north of $600 million per year. And I do have to say that there, you know, all these tax credit programs are not created equal. There are some that have direct ties and direct benefit to the community, and where there's others that do not. And another note about this chart is that it doesn't include special sales tax exemption programs, which we've kind of seen a trend moving towards that. In this past session, there was as you see, we have a tax credit program around data centers, and that program ends, and what we've started instead is a sales tax exemption program for data centers. So, which we expect to balloon up to hundreds of millions of dollars over the next couple years. So we were at a program that was around $7 million cost, and that's going to go up exponentially. Those kinds of programs are not captured on this chart or in that 600 million. Next slide, please. So, like I said, not all tax credits are created equal, and all the ones that you saw on the previous slide, they all target corporations. But what about working people? We've seen over the course of the pandemic, the rich are getting richer. Our billionaires in Pennsylvania, we got to add a new one. They've increased their wealth by more than $4 billion. And I know many of you, you know, you live and work in these communities, and you've seen the pain and the hardship that a lot of folks have faced. We know that things like, you know, poverty indicators aren't actually a true representation of the need that exists in our communities. We have, the United Way has done a great job doing this report called ALICE, which is Asset Limited Income Constrained Employed. which gives us a better measure of the need that exists in our communities. And when we look at that, of who's actually living paycheck to paycheck, our poverty rate, it goes from like below 10% and balloons up to nearly 40% of households in Pennsylvania. So we know the need is great. So we need to target, we need to think of policy solutions to try to get more money into the household budgets of people across Pennsylvania, because unlike this trickle-down effect that Mark was talking about, when you give money to working people, they spend it in their community, and it is an excellent investment in our shared economic growth and well-being. And you know, just like Pennsylvania, we don't lead in much. We are not leading in this space, and we don't have to guess what it would be like and what the impacts of an earned income tax credit would be, because we can just look at the other 27 states across the nation that already have a program like this. And next slide, please. And we've seen that, you know, when the state couples and creates an earned income tax credit that works in concert with the federal earned income tax credit, there's a number of really positive benefits. You keep families working, you reduce poverty, you have impacts on infant and maternal health, you know, higher performance for kids in school. It's easy to administer. It's not, you know, it's not complex. We don't need to design a new program per se. It can be issued through the Department of Revenue. And it also helps people, it helps us run a marketing campaign so that more families that qualify for the federal earned income tax credit would apply for that one as well, thus receiving more income back to their households. I think the next slide. So we do have a bill that would create this earned income tax credit program in Pennsylvania. I am calling it the Working Families Tax Credit because we do have another tax credit program that's already called EITC in Pennsylvania, and it does not do this good thing of giving money back to working people. We would do something that would be set at 30% of the federal EITC and make it refundable, which allows for people to take full advantage of the tax credit. And it's not in lieu of a tax forgiveness program, but it does build on it. And you'll see in the next slide how it does that. So the dark blue line represents our current tax forgiveness program and kind of how that tapers, like drops off at around like, what is it, like $18,000. And if we combined the tax forgiveness program with an state EITC, we see how more money is going into the pockets of average working Pennsylvanians. And you can go to the next slide. And this is who would be receiving and benefiting from that earned income tax credit. So it really is targeted to the families who are in the lowest 20% of working people in Pennsylvania, but that doesn't mean that it doesn't target folks who are in higher income brackets. You can go to the next slide. And in folks who are in our target, who are that lowest 20% of wage earners, the average benefit for that family would be an additional $726 per year. Now we don't know that can be life sustaining amount of money. It's not going to, you know, help them pay all of their bills or afford maintenance on their homes, but it does really make an immediate and direct impact while we work towards rebalancing the scales in other ways. And there is a cost associated with it, but it is, you know, it's worth it, right? It's because if we invest this money, if we spend the $622 million that it would take to administer a program like this, that money is going directly to working people. And like I said before, when we can get money into the community, that is something where it actually lifts all of us up. It supports our small businesses in our main streets, and it helps people have a higher quality of life and be able to navigate the world with more dignity. And without all of the unnecessary bureaucracies that exist in some of the social programs that we have. And I think I'm passing it back over to Diana.
Yeah. All right. Thanks so much, Representative Narada. I'm just going to go through a couple slides before we take some questions. So how would these tax changes impact our upside down tax system, which is the figure that we showed at the beginning? So let me break this figure down because there's kind of a lot going on with it. So this figure shows how our upside down tax system would be impacted if we were to pass the fair share tax, taxing income from wealth at 6.5%, and passing a state EITC at 30%. So the dark blue bars show how things stand currently, which I showed at the beginning. So it shows how the lowest income earners pay nearly 14% of their income on state and local taxes, which is more than 2 times what the 1% is paying. The middle blue bars show just what would happen with the fair share tax. And then finally, the light blue bars show how our tax system would look with both the fair share tax and the state EITC. So you can see by looking at these light blue bars that we're beginning to make our upside down tax system more fair with these 2 policies. But let me show you the exact same figure, but only if the fair share tax was upped to 12%. So this is, this is the exact same figure, but it shows the more aggressive fair share tax where we tax income from wealth at 12%. So you can see with both of these policies, our upside down tax system starts to flatten out to a greater extent. And I'm just going to go back, and if you can put your eyes on the top 1%, the bars, the light blue bar all the way to the right, you can see that the top 1% with the 6.5% fair share tax, top 1% is paying 7.6% of their income in state and local taxes. But then if I go to the next one, you can see that increases to 10%. So the difference between what the lowest 20% and the top 1% is paying is evening out more. So just wanted to show that slide for folks. And with that, I'm going to stop sharing my screen and see if we have any questions in the chat. And so people are welcome to type their questions into the chat, or you can come off of mute, because I think we have a pretty reasonable number of people here to be able to do that. So are there any questions? It seems like you guys answered everybody's question. Okay, here's one from Lindsay. So a local company, a largest employer, has been local shop for years and is incorporated in Delaware. Are they actually effing their taxes? I'm not sure about that one.
We actually can't get data on individual companies. We get general data, but we're not allowed to get any data on what individual companies pay. So it's conceivable. I don't know why a local company would be based in Delaware except to avoid taxes, but we can't. And if you think about it, we probably shouldn't be able to answer that question about individual companies. Even tax cheats have a right to privacy.
I just got a question about, you know, if these slides will be made available, and we definitely will make these slides available. All right, any more questions? I think you guys.
There's always a danger in talking about this stuff because people, you know, I find it fascinating. I know Representative Narada finds it fascinating. Diana does, but I'm not sure the rest of you do. But or we just did a great job explaining everything. And
Mark, it's Liana. It is interesting. It's just a lot of information to absorb, I think.
Sure.
So, you know, I mean, what's awesome is that, you know, these charts are really nice and helpful. I'm interested actually in hearing more about the second fair share tax proposal. If you're willing to wax on it for a minute. Sure.
I mean, it's in concept, it's very similar. You know, we raise the tax on income from wealth and unearned income to 12%. And that sounds like an awful lot, but still the effective tax rate on the top 1% will be far lower because, you know, they will get the break of paying less on their earnings as like everyone else. So their effective tax rate will be about the same then that it is in New York and New Jersey. But it could bring in lots and lots of money. And of course we could scale it back and even more if we don't need as much money and lower it for everyone. It would be great to have a tax system that was fundamentally fair and raise the revenues. And that aggressive proposal is much closer to what we think is ideal.
Thank you. I like it.
And Mark and I have an updated fair share tax paper that we'll release at some point. And hopefully we can include that analysis of the higher fair share tax as an option.
Great, thank you.
And both of these are the fair share tax plan as well as the working families tax credit are bills that are currently drafted and have co-sponsorship memos out. The fair share tax plan has 9 representatives on it, and the working families tax credit has 22. They are all Democrats at the moment, but I think an important thing to talk about the working families tax credit / earned income tax credit. This was championed by Republicans at a federal level many decades ago. And so it is something that does lend itself to some sort of bipartisan support. You know, it's just a matter of making sure that we put public pressure on elected representatives of saying, like, we have this giant surplus that exists in the state because of the federal infusion of money, and what better way to spend it than giving it back to working people who are living paycheck to paycheck. So if all of you would, you know, contact your representatives and ask them to sign on and co-sponsor these bills, you know, it makes our case easier to move something in Harrisburg.
Yeah, and let me add to that. I want to thank Representative Narada and the other 8 members, and I'm not going to name them all because I'd probably miss one, in the House and in the Senate. I hope it's okay, Leanne, if I mention that Senator Haywood and Senator Hughes and Senator Costa have introduced versions of the fair share tax. Yep. So support for it is growing, at least on one side of the aisle. And if people hear from their legislators, maybe we can get some other folks to join in as well. When you stop and think about how unfair our system is, and the idea that people making $1.6 million pay at half the rate that people making $20,000 make, that's just astonishingly unfair. But there's growing support, and we're really grateful for I also just posted something. There's always been a question about the constitutionality of the fair share tax under the uniformity clause. We actually commissioned a real expert in tax law, a lawyer named Richie Fader, to do an analysis. And it's pretty much an open and shut case. We've been showing this to lawyers from some of the state departments, people who had previously said, no, I'm not sure it's constitutional. And this brief convinces them pretty quickly. There's no constitutional problem with this.
All right, so I'm not seeing any other questions, but I want to thank everyone for joining us. I'm just going to share my screen one more time. To just let you know about, at 2:30 today, we're having our closing plenary, and Sara's going to join us again, which will be great. It will be a panel discussion featuring 5 progressive champions in the State House, and they're going to be highlighting their proposals to invest the billions of dollars in unused American Rescue Plan funds and surplus revenue to support Pennsylvanians who are struggling to meet ends meet. The moderator for the discussion is veteran journalist, lawyer, and lobbyist Corinna Wilson, and there will be opportunities for summit attendees to submit questions to the panel as well. So join us at 2:30, and thanks everyone for joining us.
Thank you.
Thank you.